OptionChampion.com.
Today is Saturday, October 15th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications. Nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
It was another volatile week and another round of disappointing economic news. Consumer prices increased 0.4% month over month in September, up from an increase of 0.1% in the prior month and above the forecast increase of 0.2%. On an annual basis, consumer prices rose 8.2%, below the previous reading of 8.3% and above the forecast increase of 8.1%. Excluding food and energy, consumer prices rose 0.6% month over month, unchanged from the prior month's reading and above the forecast increase of 0.4%. Producer prices increased 0.4% month over month, up from the revised decline of 0.2% in the prior month and above the forecast increase of 0.2%. Core producer prices, which excludes food and energy, increased 0.3%, unchanged from the prior month's reading and in line with expectations. And weekly unemployment claims came in at 228,000, up 9,000 from the prior week and above the forecast of 225,000. Markets were mostly lower on the week, with the exception of the Dow finishing higher by 338 points. The S&P 500 lost 54, the Nasdaq Composite lost 329, the Russell lost 20, and the VIX gained 66 cents. Crude oil lost $7.65 on the week, gold lost $51.60, silver lost $1.96, and natural gas lost 13 cents on the week. The roller coaster ride in the markets called for some position management, in particular my position in SQ. In the last episode, I had on a $10 wide short put vertical spread in the November monthly cycle where I was short the 60 put and long the 50 put with 48 days left until expiration. Since then, I've closed the long 50 put for a small profit with 38 days left, leaving the short 60 put open. A short put is a bullish position with the expectation that the underlying stock price will rise. But with the volatility in the markets, big up days and big down days, I didn't want to have a position that would benefit only if the underlying stock price rises. I wanted to continue hedging my bets, so 2 days later, with the stock trading at around $56 per share, I bought a 55 put in the same November cycle with 36 days until expiration. And sure enough, the markets tanked the following day, that being yesterday. And SQ was down nearly $5. Using that long 55 put as a hedge that would benefit from a decline in the stock price, I was able to close it for a $135 profit. The short 60 put, however, was feeling some pain. With the stock trading at $52.42 yesterday, the 60 put was $7.58 in the money, meaning it had $7.58 of intrinsic value for the buyer on the opposite side of this trade. When I initially sold this put on September 20th, I received a credit of $6.63. But now the option's intrinsic value of $7.58 exceeds that $6.63 credit, leaving me with no extrinsic value. With 35 days until expiration, I could have held on to the position to see if the stock would rally back above the 60 strike. But instead, I decided to manage my risk by adding time to the position and moving down to a lower strike price. I rolled the November 60 put down to the 57.5 strike in December for a 32-cent debit. While the 57.5 put was $4.99 in the money at the time of the trade, I sold it at $10.07. Deducting the $4.99 intrinsic value leaves the option with $5.08 in extrinsic value. So with that and having 63 days until expiration, I felt comfortable selling an in-the-money put. And finally, to hedge the new short 57.5 put, I bought a 47.5 put in the same December monthly cycle for $4.95. In the end, I'm back to having a short put vertical spread, just as I did in the very beginning, but in a later expiration cycle and at lower strikes. What started as a 60-50 vertical spread in November is now a 57.5, 47.5 vertical spread in December. Selling the 57.5 at $10.07 and buying the 47.5 for $4.95 leaves a healthy credit of $5.12 on this spread. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.